Okay, welcome everybody. This is the first steps towards home ownership. This is home buying 101 for lack of better introduction. My name's Kevin Bergeau. I'm Senior Loan Officer, Cross Country Mortgage. I've been in the mortgage industry and the real estate industry for over 30 years, which just kind of makes me old. But we're going to save all the questions for at the end. If you can, that'll be great. We're going to take you through the entire process of buying a home, financing a home, finding out exactly what the process is. So it's a lot to take in. So we're going to get started. We're going to turn our old-fashioned analog clock here. It should take about an hour. Um, and Again, we'll have a like a 10-minute period at the end to answer any questions that you might have and to take you through it. And that's actually our real goal, is to take you step by step through the process of buying a home. It's a free course. And if you like to, there are deeper dives. So we take some of this stuff and dissect it even further on our YouTube channel. Um, so uh, Please feel free to visit that. Speaking of that, so if you're on your phone, just take a screenshot of this. But if you'll see, let me get my little pointer here. There we go. Okay. So you'll see right here, that is all of my contact info. You can get to our YouTube channel, Facebook, Instagram. You can connect directly to me, and you can actually even start an application from that particular. Sorry, I'm going to bend this down a little bit. From that particular contact. So it's a link card, but I hope you find it useful, and I hope you use it often. Um, I'm the type of person you can ask as many questions as you want to. There are no silly or dumb questions. You know, I don't do what you guys do for a living, so you're experts in your field. It's the same thing here. I understand that to some people this is like algebra and it comes at you like a fire hose, and you're only going to have to use it 2 or 3 times in your life. But it's important for you to know the basics, and so I'm a big believer in the more questions you ask, the more comfortable you feel, the more informed you are, and the better decisions you make. So ask a lot of questions. I'm happy to answer them all. Okay, with that being said, let's move on. Okay, goals for the course. So first, we're going to learn the advantages of even owning a home. What's better about owning than renting? We're going to talk about the mortgage process and the first steps that you should get started with and how to prepare for them. Mortgage pre-qualification versus pre-approval versus mortgage commitment. And we're going to discuss also how your credit scores actually affect all of your options, all the different things that you can do the credit scores are very, very critical, and I'll show you different ways that you can get them up. Um, we're going to explore some basic loan programs, VA, FHA, conventional financing, jumbo, just roughly four programs, because there's 50, 60 different programs that you can use. We can't go into them all unless you have all day. Uh, but we use them in special circumstances. 65, 70%, maybe even more of all the loans are done with these programs. We're going to also talk about the 6 steps for buying a house. What is the actual process? And in this day and age, when it's sometimes difficult to get an offer accepted, we're going to talk about how to make your offer more attractive to those you're putting the offer into, to the sellers. Okay. And then we'll answer any questions you may have. So, having said that, let's get started. Okay. So, what are the actual advantages of owning a home? Well, let's look at number one and two, right, on the screen here. So, it's a good investment. So, you get back what's called appreciation. So, for every year after you've bought a home, it generally goes up in value about 4.3%. So if you bought $100,000 house, the next year it's worth $104,300. And that's We're not using recent stuff we're not using recent math to look at that. So what we're really using is a 50-year um, kind of dissection of what people get as a return. It's called appreciation. So your house appreciates at 4.3%. And again, that's over a 50-year run from Fannie Mae. So it's pretty stable. Um, and there's going to be years that it'll go up 10, 11%. There's going to be years that it will actually go down. They're few and far between, but they do happen. Look at 2007, 8, 9. Um, uh, Number two, and that takes care of one and two. So number three, equity ownership. When you buy a house, you take out usually a loan, right? But every year you buying into more equity of that. So when you look at your payment in the beginning, let's say you had a $2,000 payment. Out of that $2,000, and I'm not talking about taxes or insurance or anything like that, just the principal and interest. Out of that, you're going to pay about $300 in principal and about $1,700 in interest. And then that changes every month. The following month, you'll pay $301 in principal and $1,699 in interest. So that goes on through time, but you build equity. You start owning more of your house, and the bank or the mortgage company owns less of your house. Um, that in the beginning, and like in the first year, that adds about 2.73% to your investment, if you want to call it that, and to your equity of the house. At 5 years, it gets to 3.71%. Uh, and then, it just goes up from there. So that's buying in the equity. So add that to the appreciation you're getting, and that's not a bad return, right? But wait, there's more. Um, this is still tax deductible on your income tax as of this writing. We'll see what happens, but um, or recording, I should say. So you can, and how that works is, let's say you paid $10,000 in interest, and let's say you were making $80,000 a year. Then what'll happen is, and you pay tax on that $80,000 a year already, if you're W-2 employee. So what happens is, the end of the year, Uncle Sam says, I know we taxed you on 80,000, but you have $10,000 of interest, so you get to deduct that from your taxable income, which means we should have only taxed you on $70,000. So whatever we taxed you on that extra $10,000, we're going to give you a check back for that. So that could be 2,000 more, a little bit less, depending upon how much interest you've paid. So now add that into that. So, and to give you an example of that, on a $350,000 purchase with 10% down, and let's say a 5% interest rate, which we hope they get back down to, that payment is $15,644 over a year. If you're in the 20% bracket, that means, or 20% blended bracket, that means you would get back $3,129 as a cash on cash return. That equals almost 6%, it's 5.96%. So if you add all that up, so add that 6%, the 4.3%, the 2.73%, you're getting over a 13% return on something that, if you look over the last 50 years, except for about 2 or 3 of them, has been an exceedingly stable asset. Try and get that type of return with that type of safety anywhere in the stock market. Very difficult to do. Okay, other advantage, you get to personalize your home. You can make improvements because you own it. You want to paint the wall chartreuse, go ahead. The homeowner is you. So landlord's not going to tell you, oh, you can't do that or you can't do this. You want to decorate it, you want to put wood floors in, you can do whatever you want. And a starter home is a great way to build wealth, personal wealth. And here's what I mean. Um, I bought my first house in the, oh God, it was a long time ago, in the mid 80s, we'll call it, and bought it for $79,000. It was beautiful, nice, brand new home. We bought it for, and by the way, our interest rate when we started, 13 and a quarter percent. Oh, I'm sorry, 11 and three quarters percent, down from 13. So, when we look at rates at 7 or 6.5, we go, oh, they're so high. Well, not really. And then I refinanced 2 years later at 9 and a quarter. But anyhow, we bought that. 4 years later, we sold it for $129,000. So we netted, just about $40,000, which we used to put down on our next home, which we lived in for 28 years. So again, building wealth. Real estate is a great way to do it. And the last thing is here is the landlord can't not only not tell you what to do to your house, but he can't sell it, or she can't sell it from underneath you, because that really happens more than you would think. There was a period of time in 2003, 4, and 5 that the biggest complaints that we got were that people were selling, the landlord was saying, but you've got to move in 2 months. I sold the house. So this prevents that from happening. Okay, so let's talk about the first step. The mortgage pre-qualification approval is a great place to start, because in going through this process, you'll be able to determine your needs and your goals before you even go out looking for a home. Your lender, hopefully me, will evaluate a number of things, including credit, income, and assets and debt. The pre-qualification will help with determining your maximum purchase price that's appropriate for your objectives in the home buying process. And what I mean is the maximum may be different than what you really intend to do. Um, so you may qualify for the maximum of maybe a $500,000 loan, but you may only want a $400,000 loan. That's fine. The reason I do that is because the first year in doing this, a couple came to me and said, "Hey, Kevin, we want to buy this. We want to buy a $200,000 home." I said, "Great." Pre-qualified them, pre-approved them for $200,000. They went out looking, 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 and they found a house that they liked well enough to purchase. In conversation with them at settlement, they had found another house for $220,000 that they fell in love with, but thought they weren't qualified. Never asked me about it, thought they weren't qualified to go up that high. So they kind of settled for this house. So bingo, the light went on, and I went, okay, well, let's not do that again. So now I tell people, here's your maximum. You can buy whatever you want. Yeah, you can get approved for 500. If you want to buy 350, that's fine. There's no issue with that. So the next thing that pre-approval does in this process, it determines what payment you can expect and feel comfortable with. So we'll go through different scenarios that give you different payments, different down payment scenarios as well. And let's see what you feel comfortable with. And we'll go through the ramifications of what that payment will do to your finances. Like I said, we go a little bit above and beyond just looking at numbers and going, okay, you're approved and getting you the money. We kind of partner with you through the process to make sure that you're happy and comfortable with what's going on. We're going to set your expectations with regards to how much in assets you'll need, and we'll help you set a target for savings if you need to do that. We'll also, sometimes you have hidden issues with credit, which you may not even be aware of, and this will give you time to fix that ahead of time. And we can provide guidance on how that's done. Okay, pre-qualification versus pre-approval versus a commitment. So pre-qualification is I get all your information, W-2s, pay stubs, tax returns, bank statements. And yeah, I've got a lot of experience. Some people have less. I'll go through all your stuff and go, based on what I'm looking at, you're qualified for X amount. That's a pre-qualification. Pre-approvals, I take that information, input it to the system, and run it through the automated underwriting system. Both Fannie Mae, FHA, VA, they all have, and Freddie Mac all have their automated underwriting system. So we run it through that, and that's a pre-approval. A commitment is normally what happens is when you buy a house, and let's say you have a pre-approval, Then we would get additional information, take the agreement of sale, send out an appraisal, and send the information that we have in our system to the underwriter. An underwriter is a person who looks at and makes sure that looks at all the information we've input and make sure that it matches. Because I can put in that you make $3 million a month if I want to get you approved for a certain amount, and the computer will say, "Oh, that's great," but it's not going to ask for verification. Underwriter does, matches everything that we input to the computer and make sure that it meets all of the guidelines. So, and there's part of that process that you can do ahead of time. Um, so what I mean is you can get a commitment. Normally it's done with a house, and that's the way it's been for done for 50, 60 years when you get a house. But you can actually do it without a house. Um, we just won't send out for the appraisal, but we'll take a look at what the top is that we think you can qualify for and put it through that way. What that does for you, and we'll go into this a little bit later on, is it lets the seller know that, as long as the house appraises, as long as you don't lose your job, and as long as they can deliver clear title, you're going to go to settlement. So if they're looking at your offer and another offer, and the offers are, basically equal, if you've got a mortgage commitment, that's going to be stronger. There's nothing better than a commitment other than a cash buyer. So you're likely to, if you have 5 offers on the home, they're all relatively the same, but you have a commitment, you're more likely to get the deal. Okay, what's needed for the pre-approval and pre-qualification? Well, personal details. We're gonna need your address history, and they look at the last 2 years, Social Security number to get your credit report, date of birth, and contact information. We're going to need a complete list of all debts, which we'll get through your credit report. And by the way, we can do a soft pull, not a hard pull, so that your credit score, even though it doesn't go down as much as people intimate that it does, it won't get hit. We can, and we'll also get your employment income, and we'll get all the paperwork that we need: W-2s, pay stubs, bank statements for the last. Bank statements are the last 2 months. Pay stub is the last 30 days, and W-2s are the last 2 years, as well as if you're self-employed or for other reasons we may need tax returns. We also may need diploma, stuff like that. If you newly employed and newly graduated either college, secondary education, or trade school or something of that nature. We'll need to know the amount of money that you have and are willing to work with. We don't suggest you use your last penny. So we like to see people that have some reserves. I think that's a smarter move and a safer move. And then we'll run it through the automated underwriting system, and we'll get you that pre-approval. And we will technically or technically then we can issue you a letter. A pre-approval letter is a letter from a lender that demonstrates to the sellers that and the realtors that you're a serious buyer ready to purchase a home. And it should really match the offer. Like, you may be approved for $400,000, see a $375,000 house that you want to offer $365,000 on. It's not a good idea to give them a letter that says you're good for 400,000. It's not the best way to negotiate. But we'll go into more of that later. The commitment. So this is kind of a different track. So as I said, in a very competitive market, a commitment gives you and your agent the advantage of presenting your offer as the next best thing to a cash offer. It could also, by the way, reduce the time that you'll need to go to settlement. Typically, most mortgage companies need 3 to 4 weeks at the minimum, because we have to do an appraisal, we have to do a whole bunch of stuff to get you prepared to go to settlement, from the time you go under agreement to your day of settlement when you end up owning the house. Well, if you've already got a mortgage commitment, you've already done 50% of the work. So the reality is we could do, and this sometimes is also an advantage, you might be able to go to settlement in 2 weeks, which if the current seller has already moved out of the house, that may be an advantage for you. And again, so it reduces your closing time, allows your offer to be more competitive. And identifies again any large issues up front that we may have missed on the with on the pre-approval or the pre-qualification, and gives us time to resolve. And by the way, they do last for a while. Credit reports last for, and some of the documentation lasts for, pardon me, lasts for typically 90 to 120 days. But the, the only thing we have to do after that is, if we need to, is get updated statements. So that's not a big deal. So it can last a long time. Okay, let's talk about one of the most important things, and that is how credit scores are determined. Your credit score has become over time more and more important to life in general, but particularly to the mortgage process and the home buying process. So if you look at this little nifty graph here, you'll see that 35% goes to your payment history. And this is stuff that they should teach you in high school or college, and they don't. But 35 goes to your payment history. How long is this? Have you paid on time? 30% goes to what's your outstanding debt and what is your credit limit. So they look at the ratio of how much credit you're allowed, like $10,000 and on a credit card maybe, and how much you owe. You owe $2,000. So that's something that determines 30%. When you could have really good credit, but if you have a $2,000 limit on a smaller credit card and you have $1,800 on that credit card, it's a dumb algorithm. It'll just look at, say, oh, you've used almost everything up. You must be in danger. Something must be going wrong, which may not be the case at all. 15% will go to your credit history. How long is that history? That's why you should not erase older cards that easily. You might see a couple new cards with better terms. It's great. Go use them. Don't close down your old ones, particularly not when you're doing this process. And then how much have you, what type of credit is in use? Are they school loans? Are they, mortgages that you have, car loans, stuff like that? Or is it credit card debt? And, how often are you asking for new credit? It's a red flag if all of a sudden they see a ton of new credit applications. Okay, FICO scoring, and this has changed over time. It used to be a lot easier. Let's put it that way. So scores go down to 300. If you're 300 to 620, that's not considered good credit. That's considered poor credit. 620 to 680 is fair. 680 to 720 is considered good credit. 15 years ago, 20 years ago, that was considered excellent credit. So 720 to 760 is very good credit. 760 to 850, which is where the scoring ends, is considered excellent. I will tell you, once you get over 760, doesn't matter if you have 761 or 802, you're in the top tier of all the benefits of having a good credit score will get you in terms of interest rates and programs and down payment. But we can thank the mortgage meltdown that it's 760 now. Like I said, it used to be 720. Okay. The importance of credit history, and this is pretty easy and pretty basic, right? So if you have a history of making monthly payments on time, that indicates that you're really likely to make your next payments on time and your mortgage payments on time. And your credit score can be a factor in what type of mortgage that you get. For example, you may have a 640 credit score. You can still get a mortgage, but it's going to be much more expensive in terms of interest rate if you're trying to go conventional, not FHA or VA. And it may limit the amount of your down payment. Like if you're trying to put a 3% down payment and you've got a 620 credit score, usually that's not going to fly. So you're going to have issues. That's why another reason you might use FHA. FHA has and VA have a lot of different uses. It's not just for people who don't have good credit or don't have a lot of money to put down. There's multiple uses you use it for. Anyhow, your credit score can also determine the amount required for a down payment, as I just went through, and the amount of money you can borrow, and the interest rate that you're offered. So all of those things. What works best? This is really simple. Pay your bills consistently and on time. It does not matter if you have a $500 a month bill or a $5 a month bill. A late payment is a late payment. It will still bring your credit score down 60 to 80 points for one late payment. Okay. And the amount of money does not matter. Maintain reasonable amounts of unused credit. Like we said, if you have a $2,000 credit limit on a particular card, try not to charge over $500 or $600 on that account. I like keeping them at least 40% or below. Um, Apply for credit sparingly and check your credit reports annually. If you look down here, and again, you can take a screenshot. By the way, the only thing you'll need today is your phone. You don't really need anything else. You don't have to rush to take notes. If you text me that you need to see a copy or you'd like to see a copy of this recording, I'm happy to give it to you. It's up on our YouTube channel, which is Home Buying University with Kevin Berju, Home Buying You with Kevin Berju. That's Berju. Anyhow, so down here, you'll see you can get one free credit report every year from these three main credit reporting bureaus. So Equifax, Experian, and TransUnion. You can get one free a year. I do recommend it. And by the way, not Credit Karma. Credit Karma is not the same thing. They do not use the same algorithm. And it's not what the mortgage industry or the car industry uses. So you might have a 720 credit score on Credit Karma, and from FICO, you've got a 680 credit score. So that's the one they're going to use. Okay, what not to do? Don't bounce checks. So don't write a check with non-sufficient or have people go into your bank and try and grab money when it's not there. Don't pay routinely late on credit cards, utilities, and cell phone bills. Don't max out, and don't make numerous credit applications. Well, that was kind of duh. Okay, let's talk about assets. Assets from the consumer standpoint can be the most frustrating thing, because when banks or mortgage companies, and they're required to do it this way, when they see large deposits in your bank account, and particularly if it's a counter transaction, like you're putting cash in, they're going to ask, where did that money come from? And there's certain rules and regulations with that. So, it has to come from a source that is acceptable to the underwriter. And if you're someone who transfers money in and out between your S1, S2, S4 accounts and your money market accounts, and then this process will undoubtedly drive you a little batty. So one of the things that I tell people, that if you know you're going to buy a house and you're 3-4 months ahead of actually buying that, going out to look, take that stuff, open up, take the assets that you're going to use, open up a separate checking account, leave it there, and only use that checking account. Little amounts in and out, they're not going to question. Large amounts, they will. And large amounts is defined by a percentage of your gross monthly income. So if the higher income you have, the higher tolerance there is for that amount. Okay, what are assets? So assets are what you as the borrower can use to contribute to a transaction, either in the form of down payment and our closing costs. Assets have to be liquid, such as cash in your bank account, retirement account that you can access, or even a gift. You're allowed to get gift funds. There's specific documentation that's required for it. So before you get a gift, please reach out to your mortgage consultant. But stuff like jewelry, cars, they're not liquid, so they're not considered assets by any lender. Some best practices with assets. Again, if you can put stuff into a separate checking account and not use that account, that's the easiest way. It'll make your life a lot easier. Limit the amount of non-payroll large deposits. If it's payroll, that's fine because we're going to see that it's payroll. Particularly, almost everybody has direct deposit now. But if you do have a large one-time deposit, or like you're selling a car or something like that, talk to your mortgage consultant ahead of time because they can give you some great tips on how to get that done. And you have to submit when you submit to us or to anybody, you have to give the whole bank statement. You can't redact, when you went, how many times you went to the convenience store or different things that you're doing. It's not the Pentagon Papers. So it has to be every page also, because like Wells Fargo, the last page is always blank when they get the statement. But when an underwriter sees 6 out of 7 pages and they don't see the seventh page, they're assuming that you're hiding a loan on there or something. So, okay, let's go into how much can I afford? It's good stuff, right? So lenders will use your credit history and debt to income ratio to determine the amount of loan that you qualify for. So they take how much debt you have and divide it by the amount of income. Debt to income ratio is typically the anticipated total housing payments plus your existing monthly debts. Here's what I mean by monthly debts. Most people don't have your utilities on your credit report, so that doesn't count. It's really just going to show up, or your car insurance, stuff like that will not show up. So it's going to count the stuff that shows up on your credit card, I'm sorry, credit report. And it's going to look at the minimum monthly payments that you're making. That's what we consider debt, plus your principal and interest, your taxes, and your homeowner's insurance, and any PMI that you might have for the home that you're going to buy. They put them all together. And again, divide by your gross monthly income. That's before taxes. Certain loan programs actually have a different set of qualifying guidelines, have expanded debt to income ratios, so and require lower down payments. So when you get pre-approved, you'll know what you can afford and what program might be good for working with for your set of circumstances. So speaking of mortgage payment, what does your mortgage payment include? Your mortgage payment consists of 4 amounts known as PITI: principal, interest. Sorry, I'm supposed to be doing that. Principal, interest, taxes, and insurance. And for Alark, we put Mr. T. For those of you old enough to look at, I think he was in Rocky 3. He used to have a saying, "I pity the fool." So I pity the fool that has a high payment. Anyhow, this is my high humor. So you might have PMI. We'll get into that. PMI allows you to put less than 20% down. It's an insurance program that actually is for the lender. It insures the lender, because otherwise we'd all be putting 20% down, and a lot less of us would be buying houses. Okay, speaking of that, let's go into most common misconceptions. So we call it Mythbusters, right? First one that we find more frequently than I thought. A lot of people still think, because they've been told by their grandparents or parents, that you have to put 20% down to get a mortgage. No, you can put as little as 3% down, and actually 0% down if you're a veteran. So thank you for your service. We'll get into more of that on the next slide. But you can actually, again, Fannie Mae has a conventional loan program of 3%, FHA is 3.5%, and we'll go into that in just a second. Second, you need a 620 credit score to qualify that. Not true. I mean, for some lenders it's true, but for many lenders, and I would venture to say most, you can go down lower than that. Most will go down to 580. Because FHA goes down that far and it actually goes down further. We go down to 550. Now, understand that if you have a 550 credit score, you're not going to be able to do anything less than usually 10% down. So that's kind of the trade-off there, and your interest rate will be higher. Um, Next one, oh, my favorite. I love this one. All lenders and loan originators are the same. I say nay, nay, no, because the reality is, you can um, go online and get approved by I won't say their name, but it's a fast piece of machinery that goes up in the sky. Um, but you call them up, you're going to get some person who doesn't have the experience, and they're reading from script. They're not going to know how to advise you. Or you might not go there. And by the way, those pre-approvals that you get from there, most realtors that I know don't even look at them. They'll rip them up and say, no, you've got to go to either a well-known national lender or a local lender that at least we know of, to make sure that it was done properly, because they try and pre-approve you in 8 minutes. You can't do this in 8 minutes, not correctly at least. Okay, no matter what computer program you use. So the other thing is too, you may get a loan officer who doesn't work there, works somewhere else, and they'll have great rates. You'll look them up and go, "This is the person with the lowest rate." Here's the issue with that. And it's always great to get a low rate and a competitive rate, but we all basically function the same way. People will tell you it's different. It's not, someone will say, well, we don't have to pay someone like Kevin. That's great, but how did you get people to go there? Well, we have a website and we advertise it. How do you pay for that advertising? So it all goes in the same melting pot. We all go through the same process. So basically, there's the same cost. Having said that, if someone's much lower in cost, the only way they can do that is they have to do a massive amount of loans, which is great. And there are people that do that. At one point in my career, did that. But what that takes away from is, because I have to do massive amount of loans, I can't answer your questions. I can't spend the time to guide you down the path and explain what everything means to you so that you can make a better decision. And in the end, that could cost you more money, and usually does, and worse decisions than having a rate that's more what the average bank or mortgage company is charging. So keep that in mind. All right, all homes are in need, or homes that are in need of renovation aren't worth the look. That's not true. There are programs that will help you and help pay for the renovations of that house. So again, in this competitive marketplace where the current first-time home buyers are really looking for houses that are already done, buy and buy on for the most part. I'm not trying to put any pigeonhole anyone into any specific category, but most younger buyers are looking for stuff that's done. If they have to go in and paint, great, but that's it. They don't want to do more. Well, if you find a house that has great bones, as they used to say, or a house that works for you, and you like the way it flows, and it's in a great neighborhood, but it's beat up and just hasn't, or it's got shag carpet or plastic slip covers, or from like a countertops from the 80s, it doesn't make it a bad house. There's going to be so many advantages to putting an offer on that house. Particularly, the biggest is all those people that are looking for the vanilla house with the white countertops and cabinets and everything else. They're not going to look at this house, so there won't be the competition that you're going to be involved in. You won't have to keep raising your price to get over the four other offers. And plus, you can get a house that you can put your own stamp on and make yours. Um, so and you can get help paying for that in the mortgage. So another myth: you can save money by not using a real estate agent. I know that with all the recent lawsuits and stuff that are happening, there's questions on, do I really need a realtor? I've been doing this for over 35 years. I was a realtor at one point, and I can tell you I bought probably 12 or 13 homes over the last 30 years, some investment stuff. And I used a realtor on every single one except for one. And that was just because I owned the house next door, and the neighbor came to me and said, "Do you want to buy my house?" That was it. I would always use realtors. They do a lot more than just show you a few houses and write up a contract. Your head would spin if you really knew what they did. So okay. And the last is you don't need a home inspection on new construction. I find that to be false too, because you're assuming that every construction company, every builder does the same great job as the one before them. That's not true. And don't always assume that the home inspectors that come from the townships that these homes are being built in is that astute at what they're doing either. So if you can, particularly on new homes as well, I would always get a home inspection. They run, five to $750. Well worth it. So okay. Don't have 20% down. Here's some alternatives. FHA, Federal Housing Administration. So 3.5% minimum down payment, lower interest rates regardless of credit scores. Like for Fannie Mae and Freddie Mac, as I said, credit scores go in buckets of 20. So, you have a 680 to 720 is one bucket, and one pricing on the interest rates, 700 to 720, 720 to 740, and so on. With FHA, the breakdown is different. There's only, really one or two breakdowns where they start charging more. And if your score is less than perfect, this might be something to take a look at. And typically we do that. So again, flexible, more lenient credit and qualifying guidelines too. There's a whole bunch which we won't go into, but it's easier to qualify in most cases with FHA. You can go down to, as I said, a 550 credit score, and the higher debt ratios give you more buying power. VA financing, zero down, literally 100% finances you can get. No monthly PMI. You do have to serve our country and meet VA eligibility requirements. Okay. Conventional financing. Here we go. So you can put as low as, if you're a first-time buyer, 3% down. So they have good payment options for that. There's a lot of first-time buyer programs. They're all basically the same. Some are a little different. There's many PMI program options. You can pay it monthly, pay it up front, do a combination of the two, where FHA doesn't really have that option. Lower monthly payments, very focused on credit and income. So that's what they look at the most. The lower debt to income ratio threshold, higher credit scores are much better and work better out for you. And if you do have a lower score, it will impact your interest rates more significantly than FHA or VA. But also with a lower score, if you need PMI, if you're not putting 20% down, that's also going to be higher with a lower credit score. And remember, rate's a funny thing. Everyone tries to get the lowest rate possible, but what good is the lowest rate if you don't get to settlement? That's the most important thing. Okay, conforming versus jumbo. So conforming is a term used to describe the loan amount, the limit that Fannie Mae or Freddie Mac will go up to, an FHA and kind of VA have their own limits. Conforming loan limits change every year, and they vary upon the number of units in the residence. So if you buy a duplex, a 2-unit, or a 3-unit, or 4-unit, that limit goes up. For a single family, in 2025, it's, I think, 805, 300. So it's pretty good. So anything above that is called a jumbo. It's called non-conforming loan. So it's a loan amount exceeding the conforming loan limit. Those are not backed and bought. You hear us say this word, Fannie Mae, Freddie Mac. They're quasi-governmental loan companies or quasi-governmental agencies that write all the rules and regulations. The reason they write all the rules and regulations is because they buy 60, 65, some years 70% of all the mortgages out there. So they have the gold, they get to write the rules. Um, but with jumbo loans, it's each individual bank or mortgage company. So they're lending out their own money. So they essentially may have slightly different rules. And sometimes they're easier, sometimes they're harder. They start out with using Fannie Mae, Freddie Mac rules as a background, and they adhere to them mostly. But they have little quirks of their own. So that's why, again, it's good to have a loan officer. There's also that conforming loan limit does change. It has different tiers. Like if you're living in Hawaii or New York, or even there's a couple communities down the shore in New Jersey, down by the beach, that have higher loan limits because typically it costs more money to buy a house in those areas, California as well. So, what's the right type of loan for you? Don't know. Have to look at all your information. But the loan programs that we discussed today offer a range of finance and down payment options. However, there's many programs that we're not covering today because we just don't have the time, and but they are available for potential changes. For example, let's say you just started up a business a year ago and you don't have 2 years of self-employment. Well, there's some programs available for you, bank statement loans, different things of that nature, DSCR loans. So interest rate is only one component of obtaining the ideal mortgage um, for your situation. And that's what you get when you work with an experienced professional. All right, 6 steps to buying a home. We're going to talk about the home buying process. Okay, step one, contact a mortgage professional because before you even go out, before you even get a realtor, you need to know how much you can spend because it's going to make a difference on the area and subsequently maybe even the realtor that you would choose. If you don't have a realtor and I'm familiar with the area that you're buying in, I've been very fortunate in my life to work with some really terrific realtors, and I can help you match up with one. I don't get anything from that. It's illegal. I would go to jail. But I'd rather see you get someone who's good at what they do and will help you go forward in the process. Um, but contact someone like me to discuss your needs, your circumstances, or provide your income and asset information, and get that pre-approval or pre-qualification at the least. Okay. Next, step two. Review your pre-approval with your realtor. Discuss your purchase options. Again, formulate a plan to go see the homes and see the homes that fit your budgetary needs. Step three, go shopping. Now, again, at this point, once we've done the pre-qualification, I might say to somebody, go out, go shopping. I'll contact your realtor. Uh, I'll let them know, what the process is and where we are and what, where we can go up to. Um, but what you really also may want to consider is still going forward while you're going out to look for a home and getting that mortgage commitment. Because again, it just puts you in a better bargaining position. So, step three, start your home shopping, stay focused, don't get discouraged. Sometimes it takes a while to find what you're looking for. Sometimes you may have to put 3 or 4 offers. I had a woman who's become a friend of mine who actually put in over 20 offers. I think she was close to 30 offers or maybe even a little bit above that before she actually got a house. And this was in 2022 when it was, you know, 8 or 9 offers on every house. Just stay focused. There's a reason that things happen sometimes. And always stay in contact with your realtor and your mortgage person because if anything in your situation changes, you want to switch jobs, something like that, let us know. We can guide you through that process. Okay, so you found a home. Now what? Okay, step four, work with your realtor. You make an offer. And along with that offer, I will, give you a pre-approval letter or pre-qualification or the commitment that matches that offer. You'll submit your offer, sometimes mostly with a earnest money deposit, your initial down payment. Every state's a little bit different that way. Um, Recently, you don't, in some states, many states, you don't even put the earnest money deposit in your first deposit until the house is under agreement. So it depends. Your realtor will guide you through that. Step five, we're going to order the appraisal. Now, if again, once you go under agreement, congratulations, it's an awesome feeling. And then you go, oh, what do I have to do now? See, you've got to do a home inspection. If you're going forward with that, we have to do an appraisal. And if we haven't done the mortgage commitment, we're going to make formal application to the mortgage company. So that's when we're going to look at documentation we have and say, hey, this is good. We're going to make a formal application. You'll get that via email. You can sign it all in DocuSign, and whenever you want to upload, we have a portal that you can do so safely. And then we'll send it to underwriting if you don't have a commitment yet. And then if you do have a commitment, then the loan will be, after we get the appraisal done, the loan will be reviewed for final underwriting, where you get what's called a clear to close. Okay, step six. Again, if you don't have this yet, you'll receive the final loan approval, which is a clear to close. We'll review the final closing costs. So I'll go through everything with you. And by the way, just so that you know this, when you find a house, you're going to text or call and say, hey, we found this house. We think we're going to put an offer in. Can you show me what it would look like? I always give um, a sample worksheet so that you'll be able to see how much money you need up front, what your monthly cost will be, so that we can discuss it and make sure that's still within your goals. Uh, and so 3, 4 days before settlement, you'll get a phone call from me or an email from me saying, here's what you need to bring. Here's who you have to make out the check to. It's got to be a certified check. You'll get instructions from myself and at that point, the title company as well. And then once all that's done, you twiddle your thumbs and start packing. You know, get a little nervous, get excited, and start packing. And we go to settlement. No matter what you've heard, if everybody's done their job correctly, everybody adheres to the contract, which happens more than you would think. Yeah, I know somebody's going to tell you horror stories about settlement, but if everybody's done their job, then actually settlement will be 45 minutes, a half hour, because we do most of our documents by electronic signature now, that we do it the morning of settlement. So it's really very easy time at settlement. Okay. Options on making a winning offer. We're going to go through this fast. I don't want to go over my allotted time. So we're going to get here's things that can help you in an offer. If particularly if it's a competitive offer. So if you've got 5 or 6 offers, which you can figure out if that's going to happen, if you see 20 people at the open house that you go to, you might figure out that there's going to be a number of offers. But you can waive or adjust your appraisal and inspection. So here's what I mean. When you go to do when you buy a house, go under contract, one of the things that's normally done is you go do a home inspection. You hire a home inspector for, again, 5, 6, $800, whatever it is, and they'll go through the house with you, which is really important if you can do that. They'll go through all the major systems. They'll look at any deficiencies in the house, and they'll write you often a 10-page report on what's right and what needs to be fixed on the house, and what's cosmetic and what's really important that needs to be done, ASAP. You can waive that, or you can, if you're in a competitive bidding process, you can say, look, we're still going to do an inspection. We're going to do it for informational purposes, but we're not going to come back to you with any repairs. Or you can put a limit, say, we're only going to hit you with repairs up to $5,000, and they have to be major structural defects, or, there's a lot of different ways that you can do this, and your realtor can guide you through that. You can also you can't waive the appraisal in terms of, the mortgage company is still going to do that. You can waive it if you have enough money in the bank to buy the house for cash, then you can. But other than that, you really can't waive it. But what you can do is, let's say you were looking at a $400,000 house. You ended up bidding $420,000, which sounds like a lot over. I'll go through that in a second. It's not as much as you think, but let's say it's 420 and it only appraises for 410. Well, you can go back to the people and say, look, we'll cover anything out of our pockets, anything that goes, below 420 down to 400 or 410 or 405, whatever you want to do. So if you have that extra cash to make up the difference and you're in love with the house and this is what you need to get through, you can do that. Strong financing also helps. Putting more money down. Um, Having a commitment versus a pre-qualification. A larger down payment often helps. Offer, above the asking price, you can use an escalation clause. What that means is, okay, you're asking $400,000 for the house. We'll go up to 415. We'll beat any offer by $2,000, $1,000, up to 415. So you can put a cap on it too. You can do love letters to the seller. Now, every realtor and most mortgage people will tell you it doesn't work. You're not supposed to do that. I'm not going to stop people from doing that because honestly, I never thought it worked. And then I was proven wrong time and time again. Love letters are like, we walked through your house. We couldn't believe some of the things that you've done to it. You've made it so warm. And, we looked at all the pictures of your family, and this is exactly what we want for the family that we're going to have. Just whatever, float your boat with that, you can do that. And you, again, submitting the offer with a loan commitment will help you. And there's more strategies than this, and we can go through them. When if you want, give me a call here, and as you go find out how to find a house and want to put an offer in, yourself, myself, realtor can all jump on and figure out different ways to get this done so that it works for you. Okay, let's talk about something else. Something that I'm part of. I'm one of the directors of Hero Benefits Network, which is a 501c3 nonprofit. What this does, it's a purpose-driven organization committed to honoring the individuals, because there's individuals out there who tirelessly work to improve our community, to help us. Doctors, nurses, EMS people, firefighters, police officers, and so what we do is we give them a way to provide genuine savings. I'm part of this. Certain realtors are part of this. Title company is part of this, and basically it works as a rebate to help with prepaids, closing costs, and some things you may want to get after settlement. So it's basically a rebate. It's money back, and these are some of the examples. For you, if you make a $300,000 purchase, you're likely to get $3,450 back. It varies a little bit, but again, this is a great, a really great thing that we've become part of that really makes me feel good, because there are people, and I saw this a lot during COVID. There are people who, don't have a choice. They have to work, and they go to work and put themselves at risk all the time. And, this is just their reward. And what heroes qualify: military and veterans in good standing, firefighters, healthcare, law enforcement, and that includes law enforcement that are retired, belong to the FOP, educators, unions, because I think there's only 15 or 16% of union workers in the country, and you know they don't they get a bad rap, and I think they work a lot harder, and we want to give them this benefit as well. Government employees, sometimes people take government jobs that can make a lot more in the private sector, but they choose to do this, and they choose to do it because they have that drive inside them where they want to help the person next to them. Nonprofits, there's someone who has that drive, and they nonprofits pay usually not very well. So because that's just the nature of it. And this is a way to give back to them. EMS workers. And by the way, when we say, like, look at healthcare, you can be working in the cafeteria for a hospital and still qualify. So if you fall in any of those categories, please let us know, because it's, you can get substantial money back. I mean, we've uh, given people $7,000 to $10,000 back at times. So again, that's something that is a benefit. So I want to thank you for attending. Our thing is almost empty, just a little bit left in there. Um, Also, I hope you got a lot out of this. I know it's a lot to take in. It comes at you like a fire hose. You know, please feel free to reach out afterwards if you want a copy of this. We can get you that as well. Um, And if you enjoyed this, if you got something out, please take a moment to give us. We all live by our reviews. Take a moment out and just say, hey, Kevin, I really got something out of the class. Or if there's something else that you need to know, you can do it when you do that Google review as well. And if you want to start the home buying process, you can scan here or visit this link. Um, Again, this will help you start the process. We'll go through all the steps again, and we'll come up with a number for you, and I'll be able to answer all your questions up front. Or you can visit this link. That works as well. Don't forget to visit us on our YouTube channel. Again, Home Buying You with Kevin Berjou, or Home Buying University with Kevin Berjou. A lot of good stuff, and we're really starting to build that out, um, with a lot of good information that homeowners can get. And thank you so much for spending this time with me. And again, we're going to go into, I'm not going to record the phase that we're going to do the questions and answers. So I'm going to end this part of it here. Thank you so much.